Thank you everyone for joining the sections. First of all, I hope everyone had made very decent profit from equity market last year. As the title of my section suggests, Asian equity dividend strategy, however, faced a very challenging year in 2020, as it actually had recorded the worst underperformance in the last 20 years. If you look at the chart here, the Asian equity dividend relative to the broad market index, Asia ex-Japan, in 2020, the relative underperformance was 21%. The last time we had saw such a huge underperformance was back in 1999. So what had happened in 2020 for equity dividend strategy was heavily driven by the dividend cut announcement around the globe. The announcement actually accelerated in the first quarter of the year after the pandemic happened. Looking at this chart, across the globe, we're actually seeing average of over 30% of dividend cut announcement within different region universe. Asia actually saw 38%. Emerging market ex-Asia even reached almost 60%. That kind of dividend cut announcement has detracted a lot of performance from the equity dividend strategy. Just to put things into perspective, if we are looking at the MSCI Asia universe, which consists of 1,182 stocks, about 486 stocks outperformed the Asia ex-Japan market last year. But if we are looking at companies that deliver dividend yield and outperformance, there were only 26 companies that had done the outperformance. So in short, only 2% of MSCI Asia ex-Japan companies deliver decent dividend yield and outperformance. So it was extremely difficult for equity dividend strategies to deliver decent performance in 2020. However, when we're looking at this kind of challenging environment, this is our belief, active portfolio management could come into the space and add value to investor. So when we're comparing our strategies from in last year, the Asia ex-Japan, when we're looking at number of companies that has cut dividend, Asia ex-Japan is looking at around 38%. Our portfolio actually faced less pressures on dividend cut, which only 26% of our investment actually saw announcement in dividend cut. And in terms of the 2021, we only had about 4% of our company looking at dividend cut versus 8% in the index. And from a total return perspective, which is looking at the charts on the right, last year, Asian equity dividend strategy yield almost 0% total return for investor, where our investment strategy actually had delivered 14%. So we believe active management could actually help to add value, and how we're doing this is through a dynamic approach. The dynamic approach, we believe, is extremely crucial, and at the same time is time test. We are looking at to maneuver among different, three kind of stock characters, including stable high yield, cyclical high yield, and structural growth stocks in the universe. So the stable high yield, we're referring to companies that have a much more steady dividend profile. And this is generally being categorized as telecom companies, utilities companies. And secondly, the cyclical high yield is more sensitive to their business cycle, and they could look extremely attractive when they're bottoming out from their cycle. And these sectors would generally be sectors such as real estate, technology hardware, that also pay dividend. And lastly, is the structural growth, which you had just heard about. Louis and Chen Jun mentioned about the structural growth stories, which includes e-commerce and internet. So we believe maneuvering in these three categories of stocks could help us to ride through cycles, to minimize the impact of dividend cuts, such as what we saw last year, and then anticipate a higher dividend recovery. This is what we're expecting in 2021. And at the same time, enjoy some structural growth return by strategically allocating in some structural growth sectors. So after all this, how we are looking into the equity dividend strategies in 2021 is that we are actually much more positive than last year, that we think 2021 would be a Goldilocks year for equity dividend strategy. We are looking at three criteria and factors driving such view. First is the normalizations in 2021. Secondly is the increase and resumption of dividend payment. And lastly is the low interest rate environment. So when we're looking at the normalization in 2021, we could compare this chart on the left here. Last year, on the gray bar, you are seeing a very bumpy and very diverging kind of GDP growth from a macro level. Only a handful of countries which has exhibited a very strong and solid risk containment during the pandemic actually recorded positive GDP growth, such as China, for instance. The vaccines, we believe, will unlock a much broader recovery among the regions. As you could see in the blue bars here, that we'll be expecting all countries will be contributing positively from a GDP growth perspective. And similarly, if we are looking on the earnings per share side, which is the chart on the right-hand side, this is a very similar pattern that last year we saw a very uneven earnings per share profile across the region. And this year, the vaccines is looking to help different regions to gain positive earnings growth and see a very solid rebound, which generally looking at above 25% across the region. So the whole backdrop of this paint a very positive outlook for Asian corporates in particular and help them to strengthen their financial status. We like Asia for two key reasons from an equity dividend perspective. I think there are two ingredients which are very crucial. Firstly is the free cash flow. Free cash flow, companies that are being able to generate free cash flow means this is a very natural source for management to reward shareholders. Companies being able to generate free cash flow is likely to sustain dividend and positive dividend growth outlook. And also on the right-hand side, when we're looking from Asian corporates' net gearing ratio, it's also much lower than the other part of the world. That also means companies are less stressful when it comes to the considerations of dividend payout. All this combining together, we'll be looking for a very strong rebound in dividend resumptions in 2021 as the second part of the investment thesis. Looking at the chart on the left, we're seeing the dividend per share revision has picked up swiftly in the second quarter of last year. And Asia and China, the charts on the right, you're actually seeing there are much more companies that will be expecting to increase their dividend in 2021. Asia, China is leading that compartment. And lastly, when we're looking at the overall global interest rate environment as well as the liquidity backdrop, we're seeing the low interest rate is going to sustain in 2021, with majority of the major economies in the world maintaining at 0.1 or 2, almost like net zero interest rate. By considering inflation, that means every person putting $1 in the bank is generating negative return, because obviously the real interest rate, it could be negative. And secondly, it's about the liquidity that we're looking at on the right-hand side. This is the global central bank's balance sheet expansion. In last year, we saw almost 8 trillion of balance sheet expansion, US dollar, during the pandemic. That scale is unseen in history. Even when we were looking at 2008 during the global financial crisis, there was only about 2.5 trillion US dollar in the global central bank's balance sheet expansions. So this massive liquidity backdrop together with the low interest rate era will actually be sustaining the demand for equity dividend in 2021. So in summary, we believe this year we'll be seeing a very different kind of market situations and risk appetite for equity dividend strategies. The normalizations of the economy, the resumptions of dividend payment, as well as the low interest rate environment is going to support this thesis. So this is the end of my presentations, and thank you very much for joining these sections.